Welcome, everybody. Thank you so much for joining us. We are here at TRD Talks Live. I am James Kleimann. I'm the managing web editor here at The Real Deal. And in case this is your first time joining us, let me quickly explain what we've got going on today. So this TRD Talks Live is a brand new product that we've launched because, well, frankly, the coronavirus pandemic has dramatically changed how we work and how we live. And so we thought the best service we could provide our readers were real-time discussions with market leaders who are reacting to the insanity and planning their next moves. So we're doing this every Monday, Wednesday, and Friday. And we've already had some really fascinating discussions. And on Wednesday, we've got a resi brokerage leader, a few of them in Miami, to hear a little bit about how they're dealing with the pandemic. And on Friday, Evie Solomon is going to talk a little bit about prop tech and some of the innovations that could lessen difficulties during this really wild quarantine. But enough about what's up ahead. Let's talk about what's going on right now. So today we're speaking with three experts and leaders in the residential lending space. We've got Alan Rosenbaum, we've got Ace Watanasuparp, and we've got Mark Favaloro. And so this is all really exciting, and we're going to get to that in just 1 minute. But before we do that, I just wanted to quickly thank our sponsor. We've got City Connections, which happens to be celebrating its 30th year in business. So good on those guys. And just so everybody's aware, these sponsorships allow us to keep these webinars accessible to everyone. So a lot of TRD's great content is behind a paywall, but this is not. And the reason it's not is because people like David at City Connections and others are stepping up and allowing this to be accessible to everybody in the industry. So I just wanted to thank them, and also note that not everyone can afford a sponsorship, but we really do appreciate if you could all subscribe to The Real Deal and support the journalism that we're doing. And we are working around the clock to keep the industry updated as news breaks, and there's a lot of news that's breaking. So I just wanted to give a quick message or rather, I want to have a quick message from City Connections. So we'll be back in just about a minute, and then we'll get to the chat.
In 2004, we became the first successful high-split firm. Many companies have tried it, but we were truly the first that became successful. And right now, we have approximately 100 brokers, and we do residential sales, apartment leasing, office leasing, retail leasing, and even some investment sales. We're the only company out there that will pay 95% commission splits and yet provide all the services and support, big office, complete support staff. No one else is doing that. No one's even close. On your first $90,000 worth of commissions you bring into the company, you get 70%. Then after $90,000 you bring in, you go to 95%. You can get all the help you want. I function as a sales manager, we have consultants, we have meetings, but the truth of the matter is we don't have expensive middle management, and most of the brokers at my company, they don't want to be micromanaged. They know what they're doing, and if they have a problem, they know we're here to help them, but as long as they're doing the right thing, I let them do their thing. I teach ethics for the Real Estate Board of New York. I'm also on the Residential Board of Directors. It's good to know that in 30 years, I don't think there's a single agent that can say that David Schlam retraded or didn't keep his word. I think the people in our business, the managers, the owners, are aware of that. And it's not the brand, it's not technology. It really is about relationships. Does your client trust you? Reputation is really, really important. And I'm really proud of that. 95% splits do not suck.
Okay, well, thank you for joining again. I wanted to start off by introducing our three guests today. So here on the right side of your screen, you have Alan Rosenbaum, and he is the founder and the CEO of GuardHill Financial. They are a Manhattan-based lender and brokerage. The firm is pretty big in New York, but Alan also has offices in Long Island, in Connecticut, and also in Beverly Hills. And GuardHill originates over $1 billion annually. So Alan, thank you so much for being here. And we also have Ace Watanasuparp, and he is the Executive Vice President of Residential Lending in New York for Citizens Bank. And prior to arriving at Citizens, he served as the President of DE Capital, which I believe is the debt arm of Douglas Elliman. And I read somewhere that Ace also played basketball at UConn, which is very cool. And Ace, thank you so much for joining us.
Of course, happy to be here. Hope everybody's staying safe. And thank you for having me, James.
Thanks. And finally, we also have Mark. And Mark, you are right now the CEO and owner of AmTrust Mortgage, which is one of New York's oldest mortgage brokerages. And Mark, you're also the president of the New York Association of Mortgage Bankers. Thank you so much for coming.
Thank you for having me.
All right. So I wanted to start off with you. We've seen a lot of reports that unemployment rate is rising, workers are taking pay cuts or furloughs, and so banks are expecting a lot of mortgage borrowers are going to have difficulty making payments. Can you talk a little bit about the discussions you're having with clients right now?
So we've had communication with GSEs, which really it's a government enterprise that helps Fannie and Freddie create relief programs, right? So we've had discussions in regards to creating a 90-day forbearance for our consumers. Almost every single bank has gone to a 90-day forbearance, and it can even allow consumers to go all the way up to 12 months. But it really depends on their ability to show financial hardship. And something that I want to tell everyone, to all of our listeners and audience right now, is that this forbearance period is a program that's created to really have consumers that are actually in hardship, right? We don't encourage consumers that can pay or have the ability to pay to enroll in this program, because there are things that may hurt them down the line if they participate in this program. And just remember that it's not a waiver, it's a deferment of payment as well. So I just want to make that clear to everyone that's listening here.
Does that mean that you're extending the loan terms? So if something were to expire in 30 years now, it's 30 years and 3 months, or how is this manifesting exactly?
Correct. It's still a very fluid process, but as of right now, what we do know is that it will be deferred for 3 months, and depending on the bank or the financial institution, the repayment period will be different from each financial institution.
Gotcha. And Alan, I wanted to ask you, your client base is a little bit different than that of a traditional bank. Can you kind of talk us through a little bit about the discussions that you're having with your clients who tend to be targeting different types of loans?
Right. Well, so we're explaining the whole process to our clients these days and explaining that they're actually very fortunate to be in the refinance process where they're actually bringing their monthly payments down, sometimes $1,000 a month or even more. So we're trying to explain to them, like Ace was saying before, we're trying to coach them not to ask for these programs unless it's really necessary. Most of our clients are in the financial services industry here in the New York area. And again, if they could afford to make the payment at 4% and now they can make it at 3%, please do so without trying to take advantage of loopholes, because there are people, mostly in the transportation, restaurant, hospitality industry, that are actually losing their jobs, and they're the ones that are going to need this type of work or this type of help going forward.
Alan, is it fair to say that very few of your clients are going to be losing jobs because of that? Or, obviously you know your client base pretty well. It's typically a little bit more, upper class.
Well, we certainly hope that no one's going to be losing their jobs. A lot of our clients, it's much more strict these days than it has been in the past as far as qualifying for a loan. So many of our clients have reserves that can basically cover, if you're unemployed for up to 3 or 4 years, they have reserves that they can make these payments even if they do become unemployed. So, there are hardships out there. Many of our clients should be okay if their particular sector gets hit. The financial services sector so far, it's so good. So I have not heard of many layoffs at this time in the financial services sector.
Mark, I wanted to jump over to you. You represent mortgage brokers across the state, and I know that the federal government has taken steps to add liquidity to the mortgage market. How has your membership reacted to some of the moves coming from the federal government thus far?
Well, we're happy that they've come to terms on what it is that they're exactly doing so that consumers can get moving on with what it is they want to do. The uncertainty alone was stifling new mortgage applications from coming in. And I'm hoping that with Ginnie Mae and their announcement of these pass-throughs that might add some liquidity into the government.
Mark, can you elaborate a little bit? What did Ginnie Mae do for the people at home who don't know?
Well, I think some of your other panelists may be better suited to answer this question, but Ginnie Mae in the last 2 days has offered servicers an opportunity to have a pass-through for interest and principal on some of these mortgages where there will be deferred payments, and Ginnie Mae will cover those payments. So I don't know how for long. I do not know what other details there are, but that has provided maybe a little bit of ray of sunshine in otherwise cloudy environment of the government loan sector. Been a lot of changes to FHA, particularly with higher FICO scores being required and so forth.
Can you guys give us a little bit of background on the types of loans that you're making? Ace, why don't we jump to you? Where's your sweet spot? How many loans are you issuing in a good year? How many of them are Fannie Mae, Freddie Mac loans? How many jumbo loans? Give us a sense of kind of what you guys are operating with.
Yeah, I can tell you last year we did in total $28 billion, our retail side, which is really boots on the ground loan officers. We did around $9 billion. So, our platform here is we have a huge balance sheet that we actually lend on. So here in New York in particular, we're able to do the high net worth clientele lending, right? So the Wall Street financial folks, self-employment, self-owned business owners as well. But we also have our fair share of Fannie, Freddie, and FHA government loans as well. So it's a huge array of different products that we specialize in.
And are you mostly keeping those loans on the books, or are you securitizing and packaging and selling those loans to other companies?
Yeah, fortunately, we're keeping them on the books, and we will securitize and service them down the line. But because we're pretty much a portfolio lender here in New York, we hold all of our port deals, jumbo deals on our balance sheet, and that really holds well for us during this economic sort of downturn, for sure.
Now, when things are a little bit different at your company, you don't keep the loans on your books. Can you kind of explain to the people at home who don't know exactly how you guys operate, who ends up with the risk?
Right. Okay. So first of all, we do about $1 billion a year, headquartered here in the New York City marketplace. So we're very focused on co-op condo markets. We understand the market really well. I would say half of the volume that we do are in the jumbo variety. The other half are also conforming loans that are usually under $650,000. So as a mortgage banker, we work with many, many different lenders, types of customers, so that we basically can focus on putting the right customer, their credit profile with the right lender. So what we do as a mortgage banker, we'll underwrite the loans, we'll fund the loans ourselves, and then we'll sell it off to whoever has the best price and the easiest qualifying process. So securitization market's a little bit difficult these days, so we like to work with lenders that will portfolio their loans also, so that we don't portfolio the loans that we sell, or to other portfolio lenders who can really customize the transaction for our customers.
So let's talk a little bit about those companies. Who are they? How are they handling all this? Are they still hungry for new loans, or are they pulling back? What's happening with them right now?
That's a great question. Is that for me, James?
Yes.
So again, some of them are handling it very well. Now, GuardHill, we've been through the credit crisis. We've been through Hurricane Sandy. We've been through 9/11. And we know that there are blips. There are going to be times where there's uncertainty in the marketplace. And it's the strong lenders who will actually step up and help you out through this time of health and financial crisis. So we will actually focus on the lenders. Some of them are local banks here in the New York area. Some of them are national players throughout the country. Some of them are focused just on the Fannie Mae loans. So we work with the companies that are capable and that are comfortable lending in this environment. And it has been shaky. There'll be a day where they'll say, guys, it's business as usual. And then tomorrow they'll call up and say, hey, we have to pull back. The great thing is, since we work with 50 different lenders, you can have 40 lenders that might say, hey, we have to pull back. We have too much demand. We're too concerned about what's going on with unemployment. But then you have 10 great lenders that step up and say, hey, we'll take that business. And again, that's what the consumers see, or the consumers don't see the chaos going on behind the scenes. But there's a lot of chaos in the mortgage market these days, and we try to navigate that to make sure it's as smooth and easy of a process as possible.
Thanks. Mark, we know that interest rates are near a historic low, but is there any new activity happening right now? Are there existing clients who are taking the opportunity to refinance, or what are you seeing on the ground right now?
Well, we are taking applications, and interest rates really still are at historic lows. Although they were lower, they were about 0.5% lower than they are right now. And so consumers are a little confused because they're under the impression that they are a little bit lower than they are. So with a little education, we do encourage our mortgage broker members to bring the applications in, get people approved and in queue, so that when that good day does come to lock, that those borrowers are able to get some of those great rates and maybe catch it on a really super low day.
Do you expect that the Fed is going to go toward negative rates if the economy remains this choppy?
I don't know, but I don't know what effect that would have to the retail mortgage rates, because there certainly is a lot more involved to interest rates than, as we've seen with all the liquidity issues we've had, than just the Fed lowering the rate to near zero.
How are you doing underwriting right now? There's a lot of due diligence that goes into that. How do people physically do it at this point?
Right. So underwriting is really difficult right now because we want to make sure that we're providing people mortgage loans, but at the same time, we have to make sure that people are employed. And so verifying employment data is done constantly throughout the process. That's adding a little bit burden into underwriting. Also trying to work around some of these appraisal stop orders that are happening right now. Some of the sellers do not want the appraisers in their homes, so on purchase money, we're at a little bit of a standstill in some of those cases.
So what happens in those cases? Does everything just pause like the day never ends? Is it just you wait and you wait and you wait?
Well, we are at a little bit of a pause in some of those cases where the appraisers can't get into the property. And what we'll do is we'll continue to keep the documents up to date, continue to keep the file going, move in every direction that we can move in, and keep the file data valid for as long as we can, and hope that the appraisers can eventually get into these properties. In many cases, the appraisal guidelines for Fannie Mae and Freddie Mac specifically have been changed to allow for more drive-bys and more automated appraisal valuations. But if you have a cash-out refinance, you're probably waiting for the appraiser.
Gotcha. Thank you. And so I wanted to kick it over to you. You're at Citizens, and you guys are a fairly big bank. I think you're the 12th largest in the country. And are there any areas of the country that appear to be more vulnerable than others if the economy sinks? And if so, what would happen in those housing markets over the next 6 to 12 months?
I think that's a really good question, James. And, major cities such as Miami and New York, I think, we'll continue to, there will continue to be volatility in different marketplaces, right? Especially in marketplaces where you have more second homes or more investor concentration. But if you look at New York, this is a primary residence type of community. And, just touching base on what is a new normal right now, James, I wanted to kind of touch base on the question that you gave to Mark, because a lot of our customers are wondering, with the new normal of folks displaying responsible social distancing, what does that really mean for the lending environment, and how are we navigating towards a new normal? So for appraisals, what we've done here at the bank is that we've gone to a full appraisal, and if the customer isn't comfortable with someone coming into the home, they can do what we call a desktop appraisal or even exterior appraisal. But just keep in mind that if we do go to these alternative routes, that the value may be affected because they can't come inside the property. But the show must go on, so we will continue to do the appraisals. We have gone to remote closings where we'll also allow e-notarization. So for folks that are looking to close, we are working closely with our title companies, and the GSEs have also allowed them to receive gap insurance. So title companies can still close, bank attorneys can still close, doing a wet signature type of transaction. And we are seeing loans still have the opportunity to close. It's just taking a little bit more of, it takes more of a village to get the deals done, for sure.
Sure. So obviously there's a big ecosystem within the mortgage industry in getting everything done, but how are lenders dealing with the rapid changes in values? That things are all over the place over the last 2 months, and you don't quite know where the bottom is. No one does. So how do you underwrite a mortgage in such
that's a great question, James. Again, we're going to look at the comparables that we see in terms of the most recent closed, and we're going to look at the customer's value in terms of what they have internally inside their apartments as well. But as you said, the market has been volatile the last 2 months, and right now, we haven't really seen appraisal values come in low, but we have seen folks just really having a hard time, especially on the purchase transactions where the sellers are, there's the meeting of the minds where the seller has a price that they want and the market is demanding a different price, right? So we're seeing sort of a more consolidation and a new pricing strategy as we go into a very, very volatile market and what should have been a very busy spring market.
So spring is basically dead. We're seeing that a lot of companies are pretty much writing off everything going down in Q2.
Yeah.
Very few people expect to make a profit right now. Has anyone been looking into how the real estate brokerages are doing? Their stocks are slipping dramatically, and a lot of you guys work directly with agents to get deals done. What kind of conversations are you having with the real estate agents these days? Ellen, I'll start with you since I know that you work with them pretty closely.
Right. Well, James, I would say, listening to what we were talking about before, you have to remember this is a phenomena, okay, that we're involved in right now. So again, as far as values dropping, you're not really seeing that right now. We are anticipating being on the other side, being on the positive of this side, or the positive side of this virus. Let's say within 2 months, okay, maybe longer. I think that the transactions have definitely slowed down. If people can't go outside, if people are stuck in their home, they're certainly not out there looking, to buy a place right now. The good thing is it's still March. Our typical buying season is April, May, June. Most of our closings are July and August. I think we're going to have actually pent-up demand. There are going to be so many people. So I think you're seeing people moving out. I know, James, you mentioned you're in Shelter Island right now. You're probably going, it's pretty nice out here compared to my small apartment in the city.
Now, what if you give me a $4 million loan, we can talk.
You got it. All right. So people are going to people have been cooped up for a while. They're going to analyze their housing situation. And is this place too small for me? What should I be in suburbia? So I think there's a lot of pent up demand. There's lots of time for us to go on the internet and look at the houses that are on the market. So yes, obviously it's a much slower time. The last 2 or 3 weeks, things have gotten really quiet on people looking to buy and actually people looking to sell. Nobody's going to want to sell right now because they don't have anywhere to move to. Let's talk about where we think this is going in May and June, and I'm willing to forecast. You can come back and see if we're right here, and I think the real estate brokerage community is going to love this. I think you're going to see pent-up demand, and I think you're going to see a huge late spring buying market. There's going to be a lot of euphoria out here, and I think things are going to get back to normal, as we get closer to the summertime.
Thanks. Mark, how many refinancings are you seeing in your area? You're in upstate, right?
Yeah, so I'm in the capital region of New York State, and we're just seeing quite a lot of refinancing activity right now. So that's the good side of things, because although the realtors are prohibited in New York State from actually accompanying borrowers and to show them properties, at least we have that business going. And on the appraisal issue, I want to point out, since the data that's used in an appraisal is somewhat historical, or it is historical data, I agree with Alan that we're okay on values right now. There really doesn't appear to be any problem with that so far. And also, I would also agree with Alan that I think that we're going to have a surge of business when this we eventually all of this subsides and we start moving back into some kind of normalcy. We definitely will be. We were already seeing multiple offers on properties in the capital region of New York State and throughout the state of New York, and I think we'll be back to that in a big way. When, I don't know.
Well, that's the question, right?
When it happens, it will happen in a big way.
There are a lot of companies that can't sustain, a negative Q2 and a negative Q3. If this continues, how many are able to just keep operations afloat?
And that's been the big balance that realtors have tried to maintain right now, is their need for business and also to be socially responsible and avoid all the personal contact that realtors require to be effective in our field. So quite a dilemma.
Indeed. And you're running a business yourself, Mark. What's happened operationally at your company since the stay-in-place order has come through? What are the biggest changes?
So operationally, we have all of our entire staff is still going. We have a real estate firm here. We have a mortgage firm. We have a financial services division. We have a title company. We have a legal firm, but it's all related to real estate. Currently, with all of the backlog of business that we had on purchases and all of the business that we currently have coming in with refinances, we're very busy. Now, hopefully, if everything gets under control, we won't miss a beat. And I feel like a lot of the mortgage brokers and real estate brokers can survive some months of this. Now, a protracted downturn, that would be something else.
Tough. Ace, I wanted to ask you, there are a lot of non-banks out there that have been criticized for making risky mortgages. Do you see any concern right there? Are there any particular lenders that you're concerned about?
I probably won't go into any lenders that we're concerned about, but what I can tell you is with the current environment, James, we're seeing a lot of banks, retool their guidelines to just, understanding what the environment is like today. But again, I'm going to go back to what Alan and what Mark just said. There's a lot of pent-up demand. We see activity still, but there's been sort of a hiatus in terms of folks going out there and looking at property. But I can tell you, with every single downturn, there's always the opportunity to position yourselves and really understand what it means as it pertains to interest rate, right? Because interest rates are at an all-time low. Folks' buying power are that much more. So are guidelines being affected by today's environment with COVID-19? For sure. We've seen folks that have seen their stock portfolio investment portfolios be reduced by almost 40 to 50% within the last 2 months. So guidelines are changing. But I still think the process is still pretty stringent. We have high credit score requirements. We're checking financial income, bank statements, you name it. So in terms of the due diligence from each bank, we still see a really, really high emphasis on the ability to repay.
Okay, can you talk a little bit more about how you're handling mortgage payment deferments? Are you extending the terms, or are you working with borrowers on an individual basis, or is there a specific policy in place? We have a few questions, and there were a few people who weren't totally clear about that.
Definitely working on each individual basis. We do have a framework in terms of a 90-day forbearance. In regards to everyone's financial hardship, we are looking at on a case-by-case basis. And they do have the ability to extend the 3-month forbearance and possibly even transition it over to a loan modification as well, depending on their situation.
But again, they would have to demonstrate financial hardship, and there's a series of paperwork that they're going to have to go through. And I'm guessing they can't do that in person either, right?
It's gonna be tough, right? So I would say, look, if anybody's in that situation, try to be proactive. Try to really reach out to your financial institution. Show as much paperwork as you can, whether you filed unemployment or loss of income, things of that nature will always help your position in terms of communicating to the banks your financial hardship.
Oh, and I wanted to talk to you a little bit about the high-end market in New York City. You guys specialize in making loans to people buying $3 million, $4 million, $5 million, $50 million home purchases. Has that market dried up, or are there any deals taking place right now whatsoever?
Right. Well, actually, prior to 3 weeks ago, the market was really strong again. The market was coming back in a big way. Stock portfolios were performing very well. Interest rates were low. We started to pick up that momentum again, and then we came to a screeching halt, a couple of weeks ago when we're all quarantined with worrying about the virus. So I would say that all sectors of the marketplace have pretty much been affected. I mentioned earlier, I know a lot of people who've left New York, and I have a follow-up point I'd like to make when I speak about that. There are a lot of people who've left New York, like yourself, who've left the apartments in New York, and they've gone out to the Hamptons and other places in the country, even suburbia, and they've said, wow, it's nice out here. I hate being quarantined, but, it's pretty nice out here. So I think you're going to see actually the Hamptons pick up quite a bit when this is over. I think that the prices had come down a little bit, and I think volume had picked up in the Hamptons. And I think now that so many people are going out there to feel, relief from the quarantine and, from what's going on, I think you're going to see that segment of the market pick up. Now, a lot of that is contingent on what goes on with equities. The high-priced properties are contingent upon the wealth factor. So if you feel wealthy because your stocks are performing, you're going to go out there and you're going to take your gain on your portfolio and go out and buy a vacation home or a really nice property in the city. If you think that if your portfolio goes down 30 or 40%, you're going to take you're going to take another look at that. So right now we're in a holding pattern, but again, like we said earlier, I think there will be pent-up demand, and based on the equity markets coming back, I think you're going to see the market pick up again.
And we've got a really good question I wanted to ask you. Someone in the comment section said many co-op managing agents have suspended closings until further notice. How are you working with borrowers who are clear to close but are waiting until the managing agents resume the closing? It's sort of that weird period that people can't.
I was going to say, James, if that's for me, that's the perfect question that I actually wanted to answer.
Great, here you go.
If you don't mind, Ace. This is something that really the managing agents, New York City real estate community is amazing. It's one of the best in the world, okay? And when we've had crises before, we've come together like no other city. We are having problems right now with the managing agents who are working remotely. And we have so many clients, we talk about, the president, the government wants to give everybody in America $1,000 to try to get the economy going again. When people are refinancing their homes, people are saving $10,000, $12,000, $15,000 per year by lowering their monthly payments. And we've been having a lot of problems with getting the managing agents, getting the co-op boards to approve a rate and term refinance where the borrower's mortgage payment is not increasing. And then we have to get the recognition stamped by the managing agent. I think a huge thing that we could all do to come together in the New York City area is co-op board members, shareholders, real estate companies come together and make an easier process to get these rate and term refinances. I mean, we can complain, Mark was talking about the appraisals are a problem. You know, there are a lot of problems out there, but one of the problems that we have that should be overcome easy is to have these great managing agents who represent their shareholders in the co-ops, make it a very, like almost rubber stamp the co-op board approvals when clients want to refinance their co-ops and basically drop their rates from 4% to 3%. We're having a significant problem these days in getting the co-op boards to approve these deals and getting the managing agents to sign off on them. So if we can come together, I'd love to meet with others in the industry, whether through Zoom or through other introductions, but that would be a tremendous help.
Well, the co-op board the co-op industry has been quite poor. The market has been down for a few years now, especially in some of the Tony areas of the Upper East Side. Have you had any interactions with the co-op managing agents lately?
Definitely, and to Alan's point, it's been quite a challenge to work with some of the managing agents just because of COVID-19, right? So, to Alan's point, New York, we have some of the best management sales teams out there. But in regards to co-op board approvals, they've actually been pretty creative. They've been able to. I've been on a couple where our clients were actually a part of Zoom calls for the board approval. So, they are working on different ways to continue the process, but it is a challenge. And one of the things that Citizens Bank is actually doing is we've gone to a 90-day rate lock pretty much on every single one of our deals, right? Whether it's purchase or refinance, just because we know it's going to take a little bit longer. But, I think all parties are staying fluid, staying creative to try to get the deals to the finish line. But, to Alan's point, there is this sort of big gap in between with everyone just displaying responsible social distancing. So,
speaking of which, Mark, you represent a lot of mortgage brokers across the state. You've been talking to them, I assume. What kind of fears do they have right now? Or are they banding together? Are they looking for new opportunities? Can you share some insights into how they're responding to all this?
Right. Well, brokers across the state of New York are definitely banding together. We've had a number of publications out for our brokers. We've been asking the New York State Department of Financial Services for extensions on regulatory compliance dates and things. So been there to offer some relief. But a lot of the brokers in New York, and we think of New York a lot of times as, the city and south of Westchester, but there's an awful lot of territory north of that. We really need Ginnie Mae to step up here because we cannot lose the FHA, the VA, and the USDA loan product in upstate New York. That is an enormous amount of the volume of business.
Mark, do you know what percentage of the volume that is in upstate?
I really don't off the top of my head, but it's an enormous, and I can tell you and I am in the capital region of New York State, so I'm kind of in between things, between the rural areas of New York and the more urban areas, but our business is about 50% government loan and 50% agency. So you can imagine what that means. And jumbo loans are somewhat non-existent in upstate New York, so that business hasn't frightened many of the consumers or the brokers here, but the loss of government loan is probably the number one topic of discussion for brokers in New York.
What are you doing about it? Are you guys lobbying lawmakers? Are you writing letters?
I think there was some of that was addressed 2 days ago with Ginnie Mae, and they're creative create some liquidity there. We'll see what else happens. But as the requirements for borrowers have been getting more and more difficult to qualify, higher FICO scores, LTV concerns, because you can't just do a drive-by on a United States Department of Agriculture loan. They are currently requiring a full appraisal. Same thing with VA. VA has not changed their standards to my knowledge. So, and neither has FHA. So Fannie Mae and Freddie Mac, the agencies have come out with guidelines on how to get some appraisal work done and have eased up the burden. But again, these are big fears that New York mortgage brokers have.
Alan, you don't really play in that sandbox as much with the Fannie Mae and Freddie Mac backed loans. But have you considered, if this does not get better, if the economy continues to tank, would you change, the underwriting process, the standards? Have you had conversations with?
We do a lot of the Fannie Freddie loans. So these are loans usually in geographic areas up to about 650,000. Honestly, Mark, those are the easier loans for us to work on. The jumbo loans are the ones that are a little trickier with the co-op boards and with assignments and things like that. So I think that quite frankly, the conforming lenders right now, the big banks have stepped up and done a nice job. Again, I think you've read recently that the Treasury's come in and bought $200 to $400 billion worth of mortgage-backed securities. So I think Mark had mentioned earlier, mortgage rates have gone up. Even though interest rates were coming down through the Fed, mortgage rates were increasing. Mortgage rates are coming back down again for the Fannie and Freddie loans because there's a lot of money being pumped in by the government. So we have so much volume in our pipeline. I was telling my salespeople for the last couple of weeks, don't focus on new business, focus on closing the existing volume. But over the last week, I'm starting to hit the accelerator again on bringing in new applications because these Fannie and Freddie loans are very safe. They're easy to do, and the rates have come down about 0.5% compared to where they were a week and a half ago.
Oh, and you mentioned that you have a sales team that's focusing on existing business and continuing to look at new business. What sort of new business are they looking at? Like where is this new business coming from?
That's a great question. All of our business, we've been here in New York City for 28 years. All of our business, we get no business from depositors, no business from, marketing agreements with the real estate companies. All of our business, 100% comes from referrals from our existing customers. So we're just doing it the old-fashioned way. We're reaching out to our customers, letting them know if they have friends or family members or coworkers, and maybe their loans have been slowed down a little bit by the big banks that have been overwhelmed. We are more than happy to help close loans. Again, if they are simple 1 to 4 family homes outside of the New York area, so if we're talking about Connecticut, New Jersey, we're still closing those loans in 25 days or less. So we want that type of a business. We want the managing agents to help out for the New York City deals, the larger deals. So we want to pump money into the economy. The best way to pump money into the economy is through refinancing. So once we can get that going, you're going to see a pickup in spending again once we're able to come out of our homes.
Thanks. And Ace, are you also able to talk a little bit about kind of the mix of new business and existing business right now? What does your day look like and that of your sales reps?
Oh, wow. I think our days start at 7 a.m., James, and it ends at 8, right? Maybe even busier working from home. So you lose track of time and you lose track of what are real hours and things of that nature. But, to your point, James, new business that's coming in, refinancing, to Alan's point, it is the backbone and the stimulus of consumers spending more money, right? And saving more money for that matter. So with rates being at an all-time low, historically, if you look at where we are today, a 30-year fix, you're at 3.5%, and it's one of those things where we've experienced here at Citizens Bank, just on a growth standpoint, our target was to do $9 billion this year. We're probably going to do $13 billion because of the refinance boom. And it's just going to sort of curtail into the purchase market as well, because the more that folks are able to save money on their current mortgage payments, they're going to be able to have more buying power, right, as they consolidate debt and things of that nature. So I think for Citizens Bank, we have bank branches as well. We're getting a lot of consumers come into the bank and retail banks and really inquiring about lowering their payments and creating a better position for themselves, especially with cash flow being top of mind in today's environment.
All right. Well, I think that just about does it. We had about 45 minutes and we filled up the entire time. I really wanted to thank all three of you for joining me today. I know this is a stressful time and you're all working from various locations, but it was a really nice chat. And again, thank you so much. I just wanted to give a final shout out to our sponsor, which is City Connections. So please check out their website. And again, as I mentioned, we have another whole slate of programming on Wednesday and Friday. We're doing this every Monday, Wednesday, and Friday at 5 o'clock. And please also subscribe to The Real Deal, support the journalism that we're working on every day. And we'll give you a 50% discount if you sign up using the code name James. So thanks again, Ace, Alan, Mark. Hope you guys have a great day. And for the rest of you, we'll catch you on Wednesday.